Welcome back to the Deep Dive. Today we are strapping in for a very tasty analysis. We're looking at the Q3 2025 earnings call for Domino's Pizza Inc., that's DPZ.
Right. And if you were watching the tape pre-market, well, you saw the reaction. It was immediate, very positive.
Highly positive, yeah. The street basically got exactly what it wanted. Confirmation that this whole hungry for more strategy, it's not just working, it's actually accelerating.
Yeah, it was a textbook bullish response, really. And it was driven by, operational clarity. The story here isn't just beating estimates by a little bit. It's about proving the core model works, even with big value pushes, and still drives profitable traffic. It's really a story about execution.
Okay, so let's look at those numbers that kind of set the tone. The headline beats were pretty solid. GAAP diluted EPS, $4.88. That'd be consensus by what, 9 to 12 cents?
Something like that, yeah. And revenue came in strong, too, $1.15 billion. Exceeded expectations, and that's up 6.2% year over year.
Impressive numbers. But the real star, the metric that really got that stock moving, that was the U.S. same-store sales figure.
Absolutely. It accelerated beautifully, came in at plus 5.2%.
Wow.
And management, they rightly pointed out, this was their strongest comp print since early 2024. Shows that their efforts, bringing customers back, they're working and gaining steam.
And investors definitely noticed. Intraday volume was almost double the 30-day average. The stock traded up pretty aggressively, almost touched $432.
Yeah.
So clearly there's some deep confidence that this path is sustainable.
Definitely. Now, to really understand, the health of this acceleration, we need to dig a bit deeper than just the headline revenue. Look at the profitability mix.
Okay.
Because on the surface, it looks, a bit complex. Income from operations was up significantly, plus 12.2% year over year.
Right, or 11.8% if you take out the foreign exchange effect.
Exactly. But then you see the reported net income actually dipped, down 5.2% year over year.
Yeah, and that sounds like a potential red flag if you're just scanning the press release, right?
It does.
But this is where the deep dive helps. You got to clarify, the dip wasn't about selling pizzas. It was entirely due to a non-operational thing, a mark-to-market loss.
Correct. It came from their investment in DPC Dash.
Which is?
That's basically the operator of Domino's in China. It's an investment, a key market for them, but it's accounting noise in this context, not a signal about how the U.S. business is doing.
Right. So if you kind of strip away that temporary investment adjustment, the underlying machine, the pizza machine, is humming along.
It really is. And you see proof of that in the supply chain gross margin. That actually increased by 70 basis points year over year.
Okay, wait. How does the supply chain margin go up when management also mentioned pressure on their company-owned U.S. store margins from inflation, things like cheese and pork? That sounds a bit contradictory.
It does, but that's where the management discipline comes in, that 70 basis point gain. They attributed it to procurement productivity. They're basically sourcing better, running the supply chain more efficiently. And that successfully offset the commodity inflation that was hitting the store-level margins. It shows really good cost control, especially while balancing this renewed demand.
Okay, that makes sense. So let's go back to that really strong U.S. comp, the plus 5.2%. You said the whole thing was driven by positive transaction counts.
Correct.
So that means people aren't just spending more, they're actually ordering more often. What stood out when you broke down the channels, like carryout versus delivery?
Well, the strength in carryout was undeniable. It surged by 8.7%.
Wow, 8.7.
Yeah. So that channel is clearly getting a boost from, the loyalty programs, those value initiatives we talked about. It shows people are definitely willing to come pick up the pizza if the value is strong enough.
But, and this is crucial, delivery wasn't suffering because of it. Delivery comps were also positive, up 2.5%.
Right. So both core parts of the business, the high margin carryout side and the higher ticket delivery side, they're growing together.
Which brings us back to value, that best deal ever, the $9.99, an e-topping large pizza. They specifically call that out as a major traffic driver, delivering, as they put it, renowned value.
It really seems to have hit the mark.
Okay, but I have to pause here and sort of challenge this a bit. Usually when a fast food place rolls out a deal that aggressive, doesn't it risk either crushing margins or just getting existing customers to trade down? I mean, I'm a bit skeptical. How is that $9.99 deal driving traffic and being profitable enough?
That's a really fair challenge. And management had a pretty compelling answer, actually. They said the deal was so effective and, importantly, profitable that their franchisees,
The actual store owners.
yeah, the folks on the ground running the numbers, they actively asked to extend the promotion.
Okay, that's telling.
Exactly. When the franchise system itself wants to keep a deal running, it tells you the extra volume and the frequency. It's more than making up for any slight margin hit on that one item. It's basically a traffic pump that pays for itself.
Yeah, that sounds like a definite green flag.
Right.
Okay, so beyond just value, they also talked a lot about innovation, not just, flashy limited time offers. The Parmesan Stuffed Crust pizza launch, for instance.
Right. And that apparently met high expectations, brought in new customers, helped the product mix.
And they handled the execution well, which can be tricky with new items like that.
And here's a kind of hidden operational point they made, which I thought was smart. They launched new bread bites flavors, garlic and cinnamon.
Okay.
They did that partly so they could simplify things in the kitchen by getting rid of the bread twists, which were apparently more complex, more manual to make.
Makes sense. If you're pushing huge volume, simplifying how things are made, especially with items that sell fast and are easy to make, that's key for quality and speed.
Precisely. Keeps the lines moving.
Okay, let's pivot back to delivery for a second and their whole aggregator integration strategy. Q3 was the first full quarter with DoorDash fully rolled out, right?
That's right. First full quarter. And management sees this as a meaningful, ongoing contributor. They expect it to help U.S. comps in Q4 and definitely through 2026. It's basically part of their standard delivery setup now.
And what's interesting there is the early data they shared on how the customer base looks different between DoorDash and Uber Eats.
Yeah, that was fascinating. Both are driving traffic, clearly, but they seem to be tapping into slightly different segments.
How so?
Well, the initial read, they said, is that DoorDash tends to bring in a more rural customer, maybe higher potential volume there too, possibly reaching customers who didn't have easy Domino's delivery access before.
Okay, and Uber Eats.
Uber Eats skews a bit more urban, maybe slightly higher income profile.
So strategically then, this isn't just stealing orders from themselves, it's actually expanding their reach.
Looks like it.
They've used this dual aggregator approach to hit both the, say, urban, higher income quick meal market and also penetrate that more rural, possibly higher volume family order market. It's like they're optimizing for two different demands simultaneously.
Exactly. It seems like a smart way to broaden the base. And that dual approach really backs up their confidence looking ahead.
Right. Speaking of confidence, let's shift to the investor context. Management reiterated some pretty ambitious guidance. They're projecting U.S. same-store sales comps around 3% for both 2025 and 2026.
Yeah, which feels bold, especially because they themselves mentioned the broader macro environment.
They did. They specifically noted a sequential slowing across the whole restaurant industry, starting here in Q4.
Right. So why are they so confident they can hit a steady 3%? The CEO basically framed it as playing offense.
Okay.
Their strategy is all about driving market share gains. They believe that by offering this strong value and keeping operations tight, they put pressure on competitor store economics, which, leads to long-term gains for Domino's as weaker players might have to pull back.
Okay, but this is where maybe we challenge that confidence again. Traditional fast food sales can be volatile, right? Because they often rely on limited time offers, LTOs. How can they claim 3% sustainable growth if promotions are always cycling on and off?
And they tackled that directly. This might actually be the most important insight from the call. They really stressed that all these new strategic initiatives,
like the aggregators, the stuffed crust.
Exactly. The aggregators, stuffed crust, the updated loyalty platform, and critically, that best deal ever, they're treating these as permanent additions, part of the base business now.
Okay. Not LTOs.
Not LTOs. They launch these things expecting them to compound growth over time. It's a fundamental shift away from an LTO-driven cycle to more of a continuously improving base platform.
That kind of structural change needs investment, though, and commitment. They also announced their first complete brand refresh in, 13 years?
Yeah, funded by the National Ad Fund, that 6% franchise fee.
And the goal there?
It's pretty strategic. They already own the value perception, right? Everyone knows Domino's for value.
Yeah.
But they want to significantly boost the perception of deliciousness. They recognize that for long-term share gains, they need to be in that sweet spot, great value, and really desirable, tasty food. So the refresh is designed to sharpen both sides of that message.
And the tech refresh is rolling along, too. The e-commerce upgrade website and mobile web is fully live now.
Yeah.
And crucially, conversion rates are holding up equal or better.
Which is key during a rollout like that. And the updated mobile app, sort of the last piece of that tech puzzle, should be out by the end of the year. Seems like they're really shoring up the whole foundation.
Absolutely. And the unit economics seem to reflect that health. Yeah. Added 29 net new U.S. stores in Q3, on track for the target of 175 plus for the year.
Yep. And that long-term U.S. store target, 7,700 stores by 2028, they said that still looks visible.
And here's another interesting detail. They mentioned their total addressable market, which they figure is about 8,500 units in the U.S., is actually expanding. How does that happen when you're already the biggest player?
Well, as their competitors struggle, especially maybe in the slower macro environment, some are closing stores. That frees up trade areas, potentially opens up new spots for Domino's franchisees to move into, maybe even get better deals on locations. So it effectively expands the opportunity set for them.
Okay, we do need to touch on the global picture, though. International comps were much weaker, just plus 1.7%. What was dragging that down?
It was mainly the lingering effects from closures in DPE markets. That's Domino's Pizza Enterprises, the big master franchisee in places like Japan, France, Australia.
Okay.
So while that was a drag, they did point out very strong performance continuing in key growth areas like India and China. So the story seems pretty clear. Really strong, sticky momentum here in the U.S., offsetting some temporary friction from specific international restructuring.
Okay, this feels like a perfect setup for our segment. This is not financial advice. We're going to use this gap you just described, the strong domestic story versus the temporary international drag, to pitch a, let's say, provocative, high-leverage trade idea.
All right, let's do it. The setup here really hinges on the idea that those U.S. initiatives are permanent, like we discussed.
Right, the best deal ever. Stuffed crust, the full year of DoorDash all baked into the base business now.
Exactly. But the stock's valuation might still be held back a bit because those international DPE issues are taking time to stabilize.
So here's the outrageous but plausible pitch. We look at initiating a highly leveraged, long-dated, bullish call option trade. We're essentially betting on 2026 being the year where things really converge.
Right. The thesis is pretty straightforward. You're betting that in 2026, you get the full year impact of this permanent value strategy really kicking in, accelerating growth. Just as those weaker international markets, maybe Japan and France particularly, finally stabilize.
Yeah, okay.
And when that temporary international, let's call it fog, finally clears, the market suddenly focuses on the confirmed domestic profitability and strength. That could trigger a major re-rating event, pushing the stock back towards or maybe even above that upper end of the recent trading range, like that 432 high we saw.
So it's basically a bet on strategic patience, amplified with options leverage. Betting that the market eventually rewards the domestic execution and looks past the international growing pains once they're not making headlines anymore. Essentially betting on operational excellence winning out during a macro slowdown.
That's the idea. High risk, potentially high reward, based on that core thesis.
Right. So to wrap this deep dive up then, the Q3 call wasn't just a standard quarterly beat. It felt more like proof that this hungry for more strategy is really working. It's translating value and innovation into sustainable traffic growth. Franchise profits are looking better, and it justifies that strong market reaction we saw.
Agreed. And that leads us to the final question, maybe something for you, the listener, to think about. Management pointed out the whole QSR industry is seeing a bit of a slowdown starting in Q4.
Right.
So does that overall slower environment actually become a catalyst for even bigger market share gains for a company like Domino's, one that really excels at delivering that sustained, well-known value?
Interesting thought. If they can keep pushing their value proposition while competitors maybe have to pull back because of the macro pressure, yeah, that could fundamentally change the competitive landscape over the next few years. Definitely something to mull over.
Indeed.
Thank you for joining us for this deep dive.
We'll catch you next time.